This is a full 2 hours course that will take you from trading like this to trading like this. In the course, we'll focus on 3 key things: higher win rate, higher reward to risk, and quality over quantity. And in these 2 hours, I'll break down exactly what makes a range or setup a high probability and show you how to avoid what makes it low probability. If you find the video helpful, share it with a friend and leave a like so it reaches more traders. Let's start. Let's start with what is high probability, because that is the main purpose and objective of this series. What is high probability? A lot of people would say A plus setup. Other people would say we're seeing a B minus setup and it goes to C setup and other setups. Now, when people say high probability, a lot of people mean just based on what I'm seeing, based on the pattern itself, it looks high probability. But the reality and the real side of it is that if my trading plan or my trading setup requires 5 confluences as an example, if I see 5 out of 5, that is considered an A plus setup, because it's a setup that I need to take because it has all of the confluences met. However, when I have a B minus setup, based on the numbers and based on logic, it feels like we are only having 3 out of 5 confluences. So it could work, it could not work. It's not the highest probability setup because it did not meet all of the confluences, but it met 3 out of 5. So it could still work. So I'll take it as a B minus setup. So when we're thinking about high probability, it's all based on the confluences, the reasons that's telling us to take the trade or just leave it. So probability equal the percentage of the confluences on our trading plan. In other words, the more boxes checked on the trading plan on the confluences, the stronger the setup is going to be. So A plus, check more of the confluences, more of the boxes. B minus, we have some of the confluences not met. That's why it's B minus. Now, the goal of this series, we have multiple goals here, and I want you to go over one by one and see if you have some weakness in some of these points. The first one is building setups with enough confluences. So I'm not going to be just looking for specific pattern and then take a random trade based on, that's not going to work. This is not how professional and profitable traders actually act. So we want to focus on setups, build setups with enough confluences. So even if you don't have a trading plan after the end of the series, you probably could even make a trading plan out of the confluences and the episodes just one by one. So enough confluences or more confluences equal higher probability trade. So that is the focus. One thing we also need to understand before we go into the series is that, and I want you to understand it, to have a realistic view of probability or realistic mindset about probability. It's not about the next trade, because that's just a coin flip. That's a 50-50 chance. We don't know what's going to happen. But when we stack the confluences, when we only focus on higher probability, this goes from 50-50 to maybe 70-30 or 60-40. It goes, it does not stay on the 50-50 probability. And this is what we need to understand, that probability shows up across a large sample, not one trade. So based on one trade, it's probably 50-50. But then the moment we have a larger sample, a larger number of trades, then this goes from 50-50 to another number, another probability. We cannot predict single outcomes, but we can predict results over many trades. Now, this is how an edge works. And if you look here, edge school, this is my community, this is my mindset, and my whole mindset and my whole theory on trading, it's all about probabilities. I'm trying to be on the side of the right probability in order to make money. So this is how an edge works. It's about the long game and not one lucky win. So it's not about your next lucky trade. It's about your next 50 trade, as an example, to make money from trading, or maybe next 10 trades to pass your funded account, as an example. Now, whatever strategy you use, because the confluences that I'm going to give you today and over the series, these are universal. That means they can be applied to any setup, any strategy you have as of now, or you can create your own. So these 10 components will make your current strategy even stronger, and they can be applied to, again, any strategy, any time frame, and any type of markets. Before we continue, I've taken everything I've learned over the past 7 years and put it into one place. It's cool. Inside, you will get the full blueprint to finally make it in trading, including the exact strategy I use every day, the edge model. These are some of the trades I've taken with my members. You are welcome to join if you are ready to make the real change in your trading. Let's continue. Starting with Confluence 1, and that is price position. Now, price position, what is it? Every trade depends on where price is in the bigger picture. When we have a wrong position, and we're going to go to the definition, but I want to show you the significance and importance of price position. When we have a wrong position, even the best setup that you can, you're trading will fail because it's not in the right position. Now, when it's in the right position, even if it's a lower probability, even it's B minus setup, it could still work. Why? Because you are in the right position, because confluences stack naturally. If price has been going up like this and we're reaching, kind of a high of the range, and you're looking for this specific setup here in order to buy, you're looking for a breakout structure, that's not gonna most likely work. Why? Because initially you are not in a good price position. That is how you understand it. So even your best setup, it could be a liquidity sweep, it could be into an SNR, it could be an OTE into a Fibonacci level. It's not going to work if it's not in the right position. So that is the importance. It could make your best setup like nothing, it's a losing setup because it's not in the right position. Now let's start with the basics. What is price position? It's the context. And when we think about context, what is it? It's where price is currently located within the market structure. So if we go and look at the recent structure or recent range, we can understand where are we relatively to that recent range. And in other words, it tells you if price is expensive, which means at highs, cheap at lows, or stuck in the middle. Now, when we think about the recent range, so let's say we have something like this. Now, price is here. Where are we relative to that market structure? We are at the highs, right? We are here. That means the price is expensive to buy here. And same thing, if we are here, price is cheap to buy. So we need to understand, are we at highs? Are we at lows? And we have some questions and we have a framework to follow, and you're going to understand this. But the thing to understand here is that if you were on a wrong price position compared to your position, compared to your trade that you want to take, the trade idea you have, and your setup, appearing at a wrong price position equal most likely failure, equal to a losing trade. So you always need to refer to the recent market structure, your recent price action leg or price action range, and then from there you can actually understand the price position that you could have. Now, why it matters? Because a good price position is going to give you more room for profit, simply more profit and less risk to be taken. When I say less risk, means that you have less risk of price hitting your stop loss, okay? Less risk of being stopped out. Bad price position is going to equal to small reward and a high chance of being stopped out. And also, to summarize this, you could have, when you have a good price position, you could have a much higher reward to risk and much higher win rate. The opposite is here. Bad price position is going to equal to much lower reward to risk and much lower win rate. Now, based on 7 years of experience, I put these two questions to judge if you have a bad or good price position. Now, these are things you will not find anywhere. Why? Because these are things that I sit with myself and ask a question. When usually do I have a good price position and when I have a bad position? It usually comes from understanding and being honest with yourself when asking these two questions. Now, the first one is, am I chasing price? And you need to be honest with yourself. Now, if price, you think that it was going up aggressively and you think it's going to reach here and you want to buy. If you were, or if you answer the question with yes, I want to, or I'm chasing the price here in order to reach this level, and I know that price is going up and will continue going up. If the answer is yes, then most likely you are in a bad position. And what's that like in the chart? It's like price flipped up and you just want to buy reaching here. So you could buy here and then going up, but the risk of being stopped out is larger. You know, it's much higher probability that it's going to hit your stop loss, especially if you play with a tight stop loss. Now we're going to go over the examples, but I want you to take these two questions throughout the whole, until the end of the video, in order to know and, judge if you have a bad or a good price position. The second question is, where would my stop loss go? So if I'm entering somewhere, where would my stop loss go? If the stop loss that you you decided to go with, if it was too wide compared to the reward or the next obstacle, so compared to the reward, the reward to risk ratio. So if I have 10 pips stop loss, and then the reward or the next obstacle or the next higher low that I can target is only 5 pips, that is most likely a bad price position. So if you thought that the stop loss is way too wide, it's a bad position. And we're going to go over the examples, but I want you to be honest with yourself when taking a position and asking these two questions. If you were chasing the price, you need to be honest with yourself. Am I in a FOMO now just to enter buy because I think price is going to go up? I cannot wait for the retracement. These two questions, when you answer them, you'll get another answer, which is going to tell you if it's a good or bad price position. Now, looking at dollar franc here, but before we go over the real examples on price position, let's think about some scenarios and if the price position is good or not. Now, we're going to look for the relationship between higher time frame and lower time frame in this case. So as price is going up, we had price retracing, breaking structure, and now we're going down. Logically here, we are creating, so this is a low, we are about to create a higher low in order to go higher, right? So if here you were looking for, as price started going up here and price is reaching here, do you think it's going to be a good price position on the lower time frame in order to look for this specific pattern to sell? Not really. So if you were seeing this, this pattern here on the lower time frame, so this is lower time frame, this is higher time frame, do you think it's going to be a good price position to actually look for sells here using this pattern? Not really. It's going to most likely fail and price is going to go up because it is not, even if it's the best setup, it's not going to be in a good price position. So price is going to continue. A lot of times, if we have a key level here, and this key level, we always want to ask the question, are we in premium or discount? Are we, buying at a expensive level or cheap level? Are we selling in an expensive or cheap level? Now, in this case, if I take my range, now regardless of the bias, regardless of anything, because price could, just break above or could, respect this level. Now, we are thinking of the logic of premium and discount, and if we're having a good or bad price position, selling here would be much better than selling here. This is simply the context. So if price goes to this key level, and then we have this specific pattern, now there is a possibility that this could actually work and price start going lower. If I say this here, so if this pattern of the lower time frame was presented here, we could actually reach this level and then start going lower. And why? Because now we have a better price position. We're not selling here at a bad level. Now we are selling at a good level, at, in this case, a premium level. Now, same thing, if we take the range from this low to this high and looking at 50%, below that 50% is a good level to buy. So if price reach here, only here, we don't buy here because it's not in a good price position. Now, this is one way of thinking. It's about where are we in the, I would say, the current range and the recent market structure. Now, if we look at this dollar franc on the daily time frame, I'll ask you a simple question. Would you be actually selling here, after this big candle here? Would you be selling here? Now, even though you made some profit maybe, but would you be selling here? Is it a good price position? Not really. And why? Because we had this big move here. Even selling here is not going to work. Now, yes, it worked this time, but if you notice, a lot of other times, it's not gonna work, and you need a big stop loss, which is gonna equal to much lower reward to risk. It's even better to look for buys when you have the confirmation, much better than sells. Now, look at this. We had this big move to the downside, and then we had a small retracement, and we had another big move. Do you sell from here? You cannot sell. Do you sell from here? You cannot sell, because we are not in a good price position. Even if you take your gap box here, from here to here, you'll notice that here we did not retrace to 50%, and then we started going lower. We did not reach 50%. We made another low here, and we have not reached 50%, which in this case is telling us that it's not a good price position to sell. So you cannot sell from here. It's not a good price position. We even prefer to look for buys. So you could look for buys here. You could look for buys here. Now, when price reach 50% of the range, then you might actually have a better price position. Now, it's better if price actually retrace here, but this one is a good price position to sell. You can sell, and after that, you see price started going lower. Anytime we go to the lows with a key level, you can actually be buying. Now, this is a very simple question here, or simple way to understand, and this is what we're going to be also discussing on the next episodes. But look at this here. What are we creating here? We're creating a high. So when we are creating a high, this could actually continue up. So I'm not going to be looking for buys, and why? It could continue up, but it could reverse at any moment. So any moment we could reverse to create the next higher low if we want to continue. So I'm not going to be buying here, because it could just go up like this and then immediately reverse, or it could reverse from here. So it's not a good price position to buy here, because the trend could end anytime. We don't know exactly. That is the concept of price position. All right. Now, when price is going lower, what are we creating here? This is a low. This is a higher low. So when price goes to a key level I'm looking at, then you ask yourself a question. Is it in a good price position to buy? Yes. Why? Because we have this low, this high. We are in the discount side. We are below the 50%, and we could buy from here. It is in a good price position. That is how you understand price position. Now, if we apply this anywhere, we have this range as an example, or we take it from here to here. We have this range. As prices coming lower, we don't sell, and maybe we buy here if we are in a key level. As price goes up into or about 50% in a good price position, this is a good price position, we sell from here. We don't buy here. Okay, you cannot buy here, you sell. Now price is going lower. After breaking the structure and after being way far away from the current structure, can you sell here? Can you sell here? Not really, because we never had. Now, if you're holding the trade, yes, you can hold the trade, but you cannot have another entry, because at any moment price could reverse. Now, you don't sell here. It's not a good price position. Why? Because let's imagine you sell here. Where could your stop loss be? And that is the main question. If the invalidation is way too far, if my stop loss is too wide, it's a bad price position. So if I enter here, where could be my invalidation? All the way here. What can I target? I don't see anything to the left. So even if you target something like this, even here, it's a much lower reward to risk. So whenever, now comparing to this here, if I enter here, where could be my stop loss? Here. And if you notice, maybe above this high. So I enter here, my stop loss here. It's not too wide. And what can I target? Maybe this next low. You see, that is an answer from me. That tells me that this is a good price position, and I will go from here. Now, I'm not going to sell from here. Why? Because I'm going to be having a wide stop loss. Now, taking the box from here to here, and this is 50%. Now, even if I enter here, where's my stop loss could be? Above the high. However, just above 50%, and we're going to be looking also at the scenarios of a perfect price position. Now, price reaching maybe a key level here. Okay, do I look for sells? Yes, because if I look for sells here and if I have a confirmation on the lower time frame, even not on the lower time frame, if I enter here, where could be my stop loss? Maybe here. What could be my take profit? All the way down here. And that is telling me that this is a good price position. So just keeping it simple like this, always buy in a good level, sell in a good level. Always try to sell at highs and buy at lows instead of buying highs. You cannot be buying highs and you cannot be selling lows. You cannot be selling here. You buy here only when you have a valid key level. So the core question remains the same. Where could be my stop loss if I enter this trade? If the stop loss is too wide, if it does not make sense, if it's even my account can't handle that, that means it's a bad price position. Even determining the price position can be just as simple as this. You zoom out and let's say we are here. All right, price is going lower. Can you sell from here? Not really. I can't sell from here. That's when you zoom out, right? So I'm zooming out. Now price started going lower. Can I be selling here? Not really. Selling here? Not really. Maybe buying here instead. Now, when I say buying here, that does not mean I'll just be randomly buying. No. When price reach a key level, when it gives me the confirmation, and then I want to pull the trigger, I ask the question, is it logical to buy from here? Are we in a good price position? Then if the answer is yes, I'll be entering. So entering here, going up. Now, when price going lower, going up, does it make sense that I can sell from here? Maybe yes. Now, price, for example, from this to this point or swing points start going up. Are we in a good price position to sell? Yes, because we are at a high. We are, making highs, we can sell. And that is the logic behind price position. All right, so it's something very simple, but a lot of people overlook it, and then what's the result? Taking a lot of unnecessary trades at the wrong price position, which is going to equal to a lot of losses, even if you take the best setup. Now finally, let's look at some bad price position examples. So if price is going up and then going lower, if we're looking at this high and we're looking for the breakout, a lot of times entering at the breakout, this is a bad price position. And why? Because a lot of people look to buy here when we have the breakout immediately and then having a stop loss below. A lot of times when we take a high, price is going to retrace lower and then going higher. So a lot of time you're going to be stopped out because you need a huge stop loss here to cover the low. And even sometime price will go to the low. And then your reward is going to be maybe lower because you're having, actually the reward to risk ratio is going to be lower, even your reward itself. Now this is example of a bad position, which is just entering immediately after the breakout. Another example is when we have a range and price is in a consolidation and then you enter randomly in the middle of the range, when in reality price could again go up to the extreme of the range. So when we have no clear or valid range, which is going to be discussing in the next episodes, we're going to be having a bad position a lot of times. So if you try to enter here in the middle of a ranging market, it's going to most likely go to the extreme level, and that's where you could have a much better price position. Now, why this is invalid? Because you don't have clear invalidation levels. This is not an invalidation level because even this here, you cannot put your stop loss above because it could still be taken. Now, this one here, same thing. You don't have a clear invalidation levels. And an example of invalidation level is when we have something like this, where price was going up and then a strong breakout structure of multiple levels, and then price is going above. And now we are in a good price position where we could sell, and this could be our invalidation level. Now what happened? You go up here, you sell, and then price going lower. So now you have a much better invalidation. Even this can be considered as an invalidation. So invalidation level should be a swing point or a level that has been respected by something that is in a good price position, that is, has done something. So it could break structure, it could take liquidity, fills a level, it needs to be a valid level. But in this here, in this ranging, this has done nothing. So it's not considered an invalidation point. Now, one more example is when we have, so as an example, prices going lower, and then after that, we have a huge candle like this. Now that is a bullish candle as an example. A bad price position will be entering here at the high. So for example, here, we're going to be looking for buys. We could have your stop loss here, all the way down here, maybe lower. That is a bad price position because after expansion moves, a lot of time we have retracement. So if you enter here and you put your stop loss here, a lot of time you're going to be stopped out. So you need to have a much wider stop loss. A good price position would be waiting for price to retrace maybe to part of the candle in order to go higher. Because if you ask a question here, based on this engulfing big candle or expansion candle, are you chasing here? Most likely yes, that means it's a bad price position. Now, good price position is when we have, for example, something like this, where we have a valid range to sell, and then price is going not only to the 50%, but to the extreme level, so extreme key level, the highest key level that you think price is going to go back to. For example, somewhere in here, this could be an imbalance, could be an SNR, could be, supply and demand, anything. So when price comes to this, this is the highest probability trade to take. Why? Because it's in the best price position that you can have. And why? Because if you sell here, your stop loss goes just above this high. So extreme levels in a price action range, they offer the best price position. Another good price position is OTE. So optimal trading entry. When I take my fib in a range, valid range, above 618 and then 279 and then also above here, this is a good price position. So if you apply this to any range, any valid range that you have, from 618, this is where you're going to be looking for souls. Below that, it's not valid because price is going to go, maybe give a reaction, go give a reaction, go give a reaction. But then when it goes to the OTE, that's where you can actually trust it more. Because now, even if you just enter here and then stop loss above, it could give you more reward to risk than entering, at the below 50%. And when you take a precise entry with a confirmation, stop loss goes above the invalidation level, now you always have much reward to risk. So limit yourself to only take trades above 618, 705, 79, and you're going to have much higher reward to risk and much better win rate. So after all of this, what is the takeaway here? What is the one lesson that we need to apply to every possible trade that we take in the future? It is that if invalidation is too far, so if we have something like this, we enter short here, invalidation is here, then the position is weak. Price position is way too bad here. The best setups, on the other hand, are going to have much smaller stop losses and large clean targets. That is the main thing to understand from the lesson here. And now, since you understand this, the price position, the next episode will be to focus on the micro picture, the smaller picture. In other words, the details in the range. Confluence 2, ranges and valid market structure. Now let me start with this. When it comes to ranges, they're very important because in my opinion, trading is all about one thing, and that is whenever I look at the chart, whenever I start my week, I'm only looking for one thing, which is a high probability range, because trading is all about that, positioning yourself inside that high probability range. And when I say range, the first thing is range is just swing point to another swing point. So this becomes a range. Now we could have a lot of ranges, prices going up, and we have a lot of ranges. Now we need to focus on high probability range in order to have a clear invalidation. So this is the importance of having a high probability range. So from here to here, we have a clear invalidation. If this is bullish, this is my invalidation point. If price goes below this, because it is a high probability range, that means I want to see price respecting the range. So respecting the low if it is bullish and respecting the high if it is bearish. So in a bullish scenario, invalidation here. Targets, if price goes lower, I can target at least this high or inside, maybe a bit below that high. And then when I have that high probability range, I will also have a key level to enter, and that key level will be in between these swing points from here to here, maybe a key level here. And we're going to be discussing a lot of other things, and we need to also apply what we learned on the previous confluence in the previous episode, which is about price positioning. So in this range, I'm not going to be looking to buy here, and I'm not going to be looking to buy here, maybe here. And we need to have a good price position that also align with the high probability range. So again, trading is all about finding a high probability range and positioning yourself inside of it. Then you will have a clear invalidation. You will have a defined target, a clear 1-2 target, and then a key level inside of that high probability range to enter from. This actually is one of the concepts that if you understand, you'll have few steps ahead in order to become a profitable trader. And this is one of the things you need to understand. That's your job as a trader, is to define a high probability range and then position yourself, enter inside of or in between the swing points. That's all. Now, when it comes to ranges and structure, we have two types. We either have a continuation structure or we have a reversal structure, or in other words, two main types of trades depending on the range, depending on the structure. Now, we have a continuation. That means you are being with a trend. A reversal is being against a trend. And logically, now even though some people would only focus on reversal, other people will focus on continuation. For me, I would say, even though reversal work, and I do take a lot of reversals, but I do admit that they are risky. Sometime I'll take a reversal trade, it hits my stop loss, then goes above, and then I'll take another one. Maybe this one will work. So sometimes I'll take, I would say, unnecessary losses or losses that are just part of the game because I'm taking a reversal trade. Reversal trades usually are risky because they are kind of in the middle of nowhere. But forget about this for now. When it comes to continuation, this is the highest probability setup that you can take. Now, continuation means we have a breakout structure. What is a breakout structure? Is price going in one side or one direction, breaking above the high, going lower, breaking above the high. So you see, we are in a trend, breaking highs and respecting lows. This is a continuation trade or breakout structure. Why? Because we are breaking highs, going up. Now, when we have this range, this becomes your range that caused the breakout structure. You look for another breakout structure after entry. So breakout structure. We also have market structure shift, and this can be happening before. So the reversal trade can happen before the market structure shift and after. That means as price is going up, and then I just take a short here based on a key level, that is a reversal. Now, what could also happen is a market structure shift and then also consider it as a reversal, which means that price is going up, going up, going up, and then we have a market structure shift. Now, when this happens, this is still a reversal trade because the market structure shift can be only internal. Now, anyway, how do we define both of these? Which one do we focus on? And what are the features and characteristics of each? Now, when it comes to continuation, it's much safer. It has a cleaner and sometimes a big reward to risk as well. And it has a clean reward to risk. Why? Because you know what to target exactly. And the game of reward to risk becomes much cleaner and much easier. And it works with a trend. So if you know and identify your trend and you can see that it's not about to end, you can always, ride the wave and you'll get a lot of trades when it comes to continuation and more reliable setups for me. When it comes to reversal, they're only valid at higher time frame key levels. So if you know how to identify the key levels that are against your trend, you can catch. Because if you notice price moves like this, it's going up. If you know how to catch these key levels and then catch this reversal, sometimes it's going to last longer, and then this is what you need actually. So you need to focus on higher time frame key levels that are on the other side of the market. And then it's much safer to target nearby key levels. So do not be too optimistic here and you'll think that you'll get, the trend will change just because you're catching a reversal trade. You only want to target a nearby key level, sometimes only 50% retracement of the range. So you need to, differentiate between these two because they all have different types of targets. So different, sometime I'll go with 5-1 and sometime I'll go with 3-1. Sometime I'll target the 50% of the range and sometime I will look for the high or low to be taken. These are the different. When you understand these, you evaluate your trade in a much better way. So for continuation, I'm looking to maybe target the high, but for reversal, a lot of times I'll be targeting, for something like this, I'll be targeting 50% of the range as an example, because this could hold or it could go lower. But in order to be on the safe side, I'll target that 50% retracement. And then we need to also understand that sometime a strong higher time frame level, it could cause a possible macro shift. That means as price is going up, sometime if it's going up for some time, reaching a key level, this could cause a huge market session shift and change in the direction. Now, as we said earlier, trading is all about positioning inside a high probability range, but the question is, how can we find and identify that high probability range? We have 3 steps that we need to find in every range in order to consider it as a high probability, because as I said, price could create a lot of ranges. Some ranges are low probability. That means the high and the low are going to be taken, and some ranges, they're going to be respected. So a range from here to here, respected and going up. This is the range I want to be being involved with. Now, 3 steps or 3 checklists here. We're going to be going one over the other. Now, the first one is the level or the range. The beginning of the range needs to be anchored. That means the base of the range needs to be held by another key level or structure. That means if price is going up and then price started going lower and they started going up, if I can see that this level here was held by nothing, was respecting nothing, it was reacted out of nowhere, I can see no key level that price or that base of the range reacted off, then that means that that level is not anchored. That means it's not strong. On the other hand, if I can see that price is going up and then here is an imbalance, respected the imbalance and started going up, then this becomes a high probability range. And why? Now, this is only one checklist, one box ticked. Now, why is that? Because it's anchored, it's respected, it's respecting another level, which is the imbalance. Now, another thing is, for example, going up, breaking structure, this base here is respecting another level, just like this. That means that level is anchored, it's held by another key level, it's respecting another key level, and that makes it partially a high probability range, the base of it. Now, what's the second thing? We need to see displacement. That means I want to see a strong move at highs or lows. That means displacement, strength above highs. And as an example, if I'm going up like this and then price started going lower, if I found it hard to displace above this and then reverse, this range here becomes low probability immediately. Why? Because we failed at highs. Now, same thing at lows. If we are going lower and you see break of structure, and now we have a new range, but this is what happened, failing to close and displace below a low. This range here becomes low probability because we failed to displace below the low. We find weakness at there. That means we have no displacement and probably the range will be low probability. On the other hand, going up like this, you see displacement, we actually displace above the high, we close strongly, and then we continue also on that same side. That means we have a displacement. And then the last thing, and this is a very important thing that a lot of people just forget about, which is the range fill. That means, I want to see a significant retracement that happened on that range, maybe 50% of the range or to the optimal trading entry. If I see it going to the 618, this is my favorite one. Also the 705, so 70.5. This is also a level that I do love to see price and the range retracing to. What does that mean? Range fill. That means if price is going up, and this is only what happened, and then break and structure. Now we have displacement. We have maybe a key level here. But what do we have missing here is that there is no range fill. That means the whole range here was only filled just to this level. Maybe we have the base anchored. We have also a displacement, but the whole range here was not filled. That means You're going to wait for price to fill the range, and then you continue to look for longs. So in short, if you have no range fill, that is a low probability range, because at some point price will reverse, and then even if it continues like this with no retracement, at some point it's gonna reverse and fill the range. So you want to stay out of any range that has filled nothing. So you have a new range just like this. Avoid taking longs here, because at some point, even if it continues, sometimes it's gonna reverse, and you don't exactly know when it's gonna reverse. Maybe you can catch the reversal in this case. Why? Because price has been overextended without retracement. So you take shorts here in order to fill the range. That is also another possible scenario, but only take this when you know what higher time frame key level you can take it from, and then you know how to trade reversals. So the moment you see these three things in a range, and this is something not a lot of people teach, maybe no one teach, because everyone has his own way of identifying the ranges. These are my 3 ways. You're not gonna find them anywhere, because this is only comes from my 7 years of experience. So the moment I see these 3 things in a range, I'll consider that a high probability range. I'll go and look for a key level inside that range, and I'll take a position from there. So you see, we're starting from a price position, which is the macro picture. Where are we in the big picture? And then looking at the ranges, these are some of the details in the small picture. So in the big picture, we have this, and then in the micro picture, we focus on the range itself, not the big picture. Okay, so we might have something like this, and then we have a range here. I'll be identifying this range. This is a micro picture, the whole picture, and the big picture is the macro picture, which we discussed on the previous lecture. Now you probably already understand and have an idea about what a low probability range is, because it's totally the opposite of the high probability range. Now low probability, just going over it very quick, it's not anchored. That means it's floating in the middle of nowhere. It has no clear level that is being respected. And then this is number 2, this is number 3. It's a weak move, so it's choppy, no real displacement, and then we have a lot of weakness at highs and lows. That means we fail to close above highs, below lows. This means that we have a choppy move, we have no clear displacement, and it's a low probability range. And then finally, it's unfilled. So there is a lot of gap below or above, leaves gaps or ignores 50% retracement. That means this is a low probability. You see, minimal retracement, you cannot be involved with this. Why? Because it's a low probability range, and initially it's not in a good price position. So if you notice, it's all connecting to each other. This is what a low probability range. You want to avoid this and focus on the high probability ranges. Now, another thing that we also want to and need to understand is macro versus micro picture, external versus internal. Now, why do we need this? In order to also be, aware of what are we involving with. Are we, trading the macro or the micro? Are we trading the external or the internal? Now, macro structure is identified by swing, the external swing highs and lows. So something like this. This becomes our external range, and it is the big picture trend direction. It's defined by external highs and lows. So if you notice, as we're going up like this, this is our macro structure. Now this sets main bias and long-term target. So if you want to look for the best scenario target, or the best case scenario, the highest target that you can reach, and maybe if you're trading based on the macro picture, that is your target. You want to avoid all of the noise, all of the details, and you want to focus on the main target, that is the macro picture. When it comes to micro, that is the internal structure. It's a short-term move inside the macro leg. So you notice this macro leg here, from here to here. What's inside is the micro structure. It's the internal. So again, external here, inside of it is the internal. We could have different biases and different directions inside of it. As long as it stays in between the external, it's an internal, and it can be in different directions. So it's defined by internal swings and shifts. It could shift a lot of times, and then it refines the entries. So if you want to have a defined entry and precise entry On the macro structure, you still want to use the microstructure because it's going to be inside, it's going to have more details. And then if you're taking short-term trades, it's going to also give you an idea about the short-term targets. So you need to understand the external and internal in order to understand what can you target actually, and can you have long-term targets or just short-term targets. It's like catching big moves or small moves, catching correction versus expansions. So a quick example of external versus internal, you can start from anywhere in the chart. The first one, the big one, when you zoom out, that's going to be your external. So as an example, swing point to swing point, breaker structure, this stays your external structure. Inside of it, we have a lot of moves. Now you could look at this from one time frame, or you could look at it in different time frames. In this example, consider this as a 4-hour time frame, for example. So inside of it, we have a lot of small moves going inside, and sometimes we have breaker structures, we have shift. You can still trade this, but be aware that the trend can change anytime because we are bearish here, but this is all internal compared to this. And then you can look for longs here when you have a good price position. Now understand, when you are involving in the external structure, this becomes your target, or maybe somewhere in here just below it, in case this is a good key level. Now you see prices going lower. When you are trading the internal, you are maybe taking a trade here and then targeting a close target. But when you take it with the external, this is your external key level here, your target becomes way too far. Now this is the external. This becomes the external range. This becomes the internal range because we're still staying inside. Sometimes you'll have structure shift as well, but this still stays the internal because we have not broken below this level, and then we go up and we have another external. Now you could be subjective here. Some people will consider this as an external here by itself. Some people will consider the whole move here external until we take the low. So it's a bit subjective, but this is the main premise here, is that internal is when price stays inside of the swing points. External is the main move or the expansion move, that a lot of times the internal stays inside. And this slide summarizes what we need to look for when it comes to thinking about the structure. All right, so that's a summary. We identify if structure is internal or external to set expectations, and then we define whether it's continuation or reversal, and same thing to set expectation. We mark out our high probability range and then we trade from it. That's all. Now we're going to go over examples, explain everything in more details, and then we see how can we apply this on the real chart and on the real market. All right, so this is dollar franc here, and what we want to do and focus on for the examples is to be able to identify high probability ranges, because that is our job as traders. Now here's the checklist. We want the level to be anchored. We want to have a displacement. Now displacement can be a breaker structure, but a breaker structure is not just a closure below with one candle. That is not a breaker structure. Breaker structure is being able to show that we are disrespecting that level with multiple candles and price going for some distance below that level. All right, so it's not only one candle thing. Now let's take a look at this. We can start from anywhere. Now, as an example of external and internal, I can start from here, consider this as my external, all right, because I can see that we had a valid range respected here. Now, where goes your external? Here. And as you can see, we started to go lower. Then we had the retracement all the way up. Now, this becomes our, we had swing high, swing low, and then we had a high probability range here respecting and causing a breakout structure. Now we started to go up. This is where we got respect. This goes as a high. Now mainly the external structure will be here. The breakout structure, that the external one is going to be here. Now, does that mean you cannot trade the internal? You can definitely do so. And you can also consider that we might have another external also inside. So if you start from here, you could consider this as an external, and this is all internal. So different ways to trade. Now, forget about this one. What you need to apply from this is that just identify your price position. Are we having a good price position? If I ask you here, is this a good price position to buy? Not really. Is it good for sales? Yes. If you're not sure, then make sure to understand the previous episode and lecture. Now, let's look at some of the ranges we have. So if we go over here, if you notice now, some of the things here I'll teach, they're only taught on H-School when it comes to the key levels, when it comes to the entries that we take, the strategy that I teach. It's only exclusive to the people that I teach on my mentorship. Now, what do we notice here? That price has been getting a lot of respect here. And then, okay, so a lot of respect here. Price starting going lower. So when it comes to being a level being anchored, is it anchored actually? Yes. Why is it anchored? Because we do have this key level, which is from here right to here. A lot of levels have been already filled. So this level has been respected. Now these are levels I teach again in H-School. You can use any level that you want to use. So you can use imbalances, you can use order blocks, whatever. Now, finally, this level, 2 levels here have been respected, and then we had a breakout structure. So most of the things here are filled already. That means it is anchored and the range has been filled, kind of filled here. So a lot of respect, and then we had a displacement. So we have anchored, we have displacement, I started to go lower, and then goes up. So we have range. So the range has been filled here, and we have displacement. Now we think about price position. So price did the displacement here, and now we have a retracement. We are filling part of the range. So we can have entry, probably the nearest key level is this one. So price comes here, started to go lower. Now, what you can trade here is you can trade based on here. Now, when it comes to the key levels, we have a breakout structure of the external. Is this anchored? Yes, because it has been respected by this level. So this level is anchored here. Now, in the future, when price, so we have a breakout structure, right? Now, we had a retracement that took a long time. The structure that we have now is the swing point, already anchored, already the range is filled, price started to go lower. We have another high that is now the high of the range, and the low of the range is here. Now, when price goes up again, what we can do here in order to confirm that we have a range fill is taking a fib from the high to the low, and we can see that it goes to OTE 7975, 705, and 618. Now we're going to take the same fib, and then we're going to mark our key levels. So the same fib goes here. You see, it's still not filled. 618, 705, 79 is here. And then you're going to look at your key levels. So, what key levels can we look at here? What do we have is key level here. Key level here is actually, this one is not. This is a key level. And then we also have this one here. And what happened is price coming to this key level and showing respect. Now, this is all external. And we could have found an entry here, depending on if you could find or not. Now, what happened is we have another internal. Now, there is a big difference I want to explain here, is that sometimes you'll have your external and your internal is going to go against the trend. And then you have an internal that is with the external. When you have this, now this one you can trade, but the highest probability one is when the external align with the internal. That means we have this external range from here to here, and it's a valid range, and then internal aligns with it. You don't need to wait for a breakout structure in order to trade this, not really. You can trust this because now the internal is aligning with the external and trade based on the internal range. If you can identify if this is a valid range, you can enter from it. Now, this is what happened here. We filled the external range, we started to go lower. Is this level anchored? Yes. Does it have a displacement? Yes. Did it fill a range? Yes. That means even this internal range, I can now trade to the lower side. And this is actually a trade I've taken with my members on H-School together. So if you notice, what are some key levels that we have? We have these key levels here. And that's what happened. Price comes lower based on the edge model. Now you could find your entry here. The entry is here. And if you notice, sniper entry, put it just below for the spread. stop loss here. Now there is sometime price is going to go up to your extreme key level, yes, but that is now what do you target here? Yes, it took a lot of time, but because you're trading the external here, the external is this is the because we don't have a valid key level here, it's going to be taken, so that is your trade. Now same thing, if you traded from here, maybe entry here, stop loss above, your target is the external. Now here your target the external as well. Now you'll have a lot of other entries here. So you see this one here where we entered, price started to go lower. Do we have anchored? Is the level anchored? Yes, because it respected this key level here. So it's held by another key level. Do we have displacement? Yes, we do have displacement because we broke below this. So 3 levels here, key levels, we broke below. Did we fill a range? Yes, we filled a range. So it's not only anchored, but we filled a range. Why? Because if we take the fib for this internal range, price reacted exactly from the 705. So from OTE, reaction from there. If you notice why we did not consider this a high probability range, the reason is there is no clear displacement. That is one thing. Did it fill the range? Yes. So it filled the range. There's no displacement. Is it anchored? Not really. So some people would consider it as, a fair value gap here. Yes. For me, it's not, because we do have some key levels here, clear ones that were not filled or not tested. That means it has a range fill, but it has no displacement and it's not anchored. That means this is a low probability. This one becomes high probability. So even if you take an entry here, targeting the external, what you can do now is based on this internal, because it's aligning with the external, from here to here, this becomes our range. What we can do is same thing. Take the fib from the high to the low, and then where do we have some key levels here? Now the thing is, there's no clear key levels here. The thing is, we have this key level, and we also take another trade here about 7-1 based on this. Then after that, price started to go up. Now even this one I would consider a high probability range. The only thing that, because it fell the 618, but then price started to go to the 705 and then break a structure. Now yes, I was looking at this as also a high probability range. It gives about 7-1, 8-1, it fails, and it's something that's totally okay. We created another key level or another range here, from here to here. The problem with this is that it was not anchored exactly. Now if you go to another high time frame, you're going to see that this is only a wick. Now from here to here, it has a range fill, it has a displacement. The anchor criteria here was not too clear for me, but then take a look at after that. What happened is, if we take the fib again from this range, because this range is aligning with the external, and then price comes to the 705, started to go lower. We don't have a clear displacement here. We have some closures, yes. Price started to go up again into, this is an edge model that is too clear. So you could have taken a short here, stop loss just above this, and then again, you target your external. And then another one here when price started to go lower, but this one has no range filled. I don't think price went to the OTE here. Okay, so was very close to it and then started to go lower. And this is how you understand. You need to balance out between, first of all, the external and internal. You need to have a good price position, and you need to apply the 3 criteria here. By me, this is something that even on paid courses you're not gonna find with the simplicity. Whenever you apply these 3 things to a range that has a good price position, and when you understand if it's external or internal, when you align the external with the internal as well, that's when you'll have success on your trading, and that's when you can actually focus only on high probability trades. Confluence 3, valid breakout structure and market structure shift. Now, a lot of people look at this specific pattern and they think that, when price takes the high, takes the low, breaks below it, this is a signature that banks leaves. And then this is where banks are involved and changing the direction of the market. And this is all illogical. This is something that does not make sense, because when you think about banks, when you think about, this is a pattern in price action that sometimes can signal reversal, but it's too misunderstood and it's too simplified, and it's looked at in many different contexts, that instead of signaling reversals, it actually keeps you losing. So it might sound funny, maybe shocking for you, but this specific thing, if you think about what's going to happen next, probably price going up and breaking the high instead of continuing lower. Why? We're going to be explaining all of this, and instead of calling this a market structure shift pattern, I'm going to call it a market structure shift trap, because it's a trap. It's like telling you that we are about to reverse when in reality it's a continuation. So the market structure shift trap, why does it fail? The reason is, the first one is that it's a pattern only. The problem is a lot of people look at this as a pattern. Oh, when I have this, go short immediately, when in reality it's going to continue up. And whenever price is going lower, whenever we break above the last high, that is a signature, and that is where smart money being involved. That does not make sense. It's only a pattern that you are looking at without context. And whenever you look at something with no context, anything, an imbalance, okay, liquidity sweep, no context mean that it's most likely gonna fail. And then why also it fails? Because you're taking it against a trend. So price has been moving up for a long time, and you think because of this it's gonna change the whole thing here. That does not make sense. So when taken against a trend, it's most likely gonna fail. And then no higher time frame alignment. So price has been moving up, and then you see this. If you don't align it with something here, probably it's not gonna work. And then if you look at this on the 15-minute and you see this happening, and then you saw this, and this is the only thing you're looking at, this specific pattern, is gonna fail. Why? Because there's no alignment with the higher time frame. That means you're not relying on a higher time frame level in order to validate the pattern. When you don't do that, it's not gonna work, and it's mostly gonna keep you losing instead. And then one of the issues also is just focusing on the last low or high. Now, the thing is not the high or low, it's about the last. So a lot of people are going to be ignoring everything, and whenever we create a high, they're going to say this is the last high, you now look for longs. And they forget about everything that happened on the trend, on the price action range, on the that high probability range. Probably they're going to focus on only the last one and forget about everything that is significant. These are 4 points. The main one is that the pattern itself is not a true reversal. When it's just marketed as it's where the reversal happened, when in reality it's not. It's a pattern that a lot of time it's more of a continuation pattern, and that's what is going to be shocking for you. If you look at this and you look for longs here, it's better than looking for shorts. Imagine that. Go to the chart, try to backtest it, and you'll notice that it's even better when you think that the market structure shift is happening. You better look for longs instead of shorts, and you're gonna see that most of the time it's gonna work more because it does not represent a true reversal, and we're gonna see that on the chart. Now, I'm not just going over this and showing you the bad side of it. No, I'm gonna show you the real side of it too, that sometimes it works, but how can we make it work? What are the things that needs to be applied, needs to be found, to only focus on the high probability ones and avoid the trap, because that's the main goal of the video, and we're going to be doing that together. Now, as I said before, 7 years of experience taught me this. You're going to find the market structure shift pattern, and it's going to appear to you anywhere on the chart, and a lot of traders, including maybe you, including me previously, we're going to think that this is a reversal now. This is where banks are being involved and this smart money. In reality, it's a trap, and price is going to continue in the same direction. Take a look at this. Price is going lower, lower, lower. And then breaking this, what's going to happen is continuation. Now, the most important rule to apply in order to avoid the market structure shift trap is to always look for it at higher time frame key levels and never in the middle of nowhere. How is that? Because that's going to give you another confluence. That's going to give you another level that could push price. For example, in a bullish scenario, it's going to push the price higher. So it's another confluence. It's something that gonna make everything from going like 50% win rate to maybe 70 just by applying this rule. And if you ask me about one of the most important rules when it comes to trading, it's the higher time frame alignment, the higher time frame key levels. Anything on the higher time frame relative to the lower time frame, that is what time frame alignment is, and that is probably the most important rule when it comes to being profitable in trading. Now take a look at this. Price goes up, break structure, break a structure, and then where's the last low here? This is your last low. Oh, we go lower and we displace below that low. What happened? Continuation to the upside. Some people get trapped here, some people get trapped here. Continuation to the upside. And then we don't break the last low. We go up. We don't break the last low. We break structure. And what happened after? People are getting trapped here, people are entering here, and then price continue to the upside. Where does the market structure shift most of the time happen? When does it become valid most of the time? Here, when we reach a key level, that is bearish. So this is a higher time frame bearish point of interest. Price started to go lower, and then we have the market structure shift, but we also have a lot of other things here, which we're going to be discussing later. And then break a structure. Retracement, that's when you enter and follow the trend. So that's the real market structure shift. All these are actually continuation. Now I want you to look at this. Price has been going up. We create a low. We go up. We take that low. Sometimes we displace below. All right. In this case, not really. We did not. But you see, here we displace below the low. That is a continuation. Now, if you consider this one here, even if you consider we were going bearish here, and then we take the low, we go above the high. That is a bullish one. In reality, it goes lower. And then the whole thing here, when price is going up, the last low is here, we displace below. A lot of people thinking that it's now time to short. What happened is keep going higher. Now we create this low. Here there is one low here, and we break below it. This one I would say it's less significant, but then price goes up. This is a low where we close below it, price continue higher. This is a low now that caused this breaker structure. What happened? Goes below it, start going higher. Also this low here, this internal one, goes below it and then continue higher. And where do we have it too? So here, kind of, but here we break structure, this retracement, going up. Now we have this low and this low. And what happened is going below them, instead of finding reversal here, instead of continuing to the downside, what happened is continuation to the upside. Now same thing here, closure below, continuing to the upside, and then we go lower. This low here, because we are bullish, the last low does not matter here. It's about where the valid key level is. And you see here, same thing. And this keeps happening over and over. It's not the reversal is not as simple as this. It's not this pattern. It's the context. It's the alignment. It's the significance of the level itself. Now, the question is, and probably that's what you're waiting for, how to identify high probability breaker structure and market structure shift. Now, breaker structure is being with a trend. Market structure shift is being against the trend. Two main rules before we go over the methods. We need to apply the price position. We need to apply the ranges and valid market structure. So whatever we learned in the previous lectures and episodes, we need to apply it here too. But we're going to be going over two methods. The first one is the two breaker structure method. Now the other one is the Edge School method. Now this one is only taught in my mentorship in Edge School. However, I'll give it for you for free for several reasons. One of them is that a lot of people, it's important to apply this in order to understand what level exactly to look for when we need to see a market shift as an example. So what levels do we consider a valid and significant one? So we're going to go over these. However, you still need to apply everything we've learned on the previous lectures. So As we said earlier, we have two methods in order to identify high probability breakout structures. The first one is the two breakout structure method. And this one, from the name itself, it's about finding, instead of one breakout structure, which is usually a trap, so something like this, where a lot of people look for this last low. And why is this a trap? Now, this is an additional thing, because a lot of times it's about this range from here, which got extended to here, because this one did no valid retracement. A lot of times there is a key level here, and it just, by the market dynamics itself, by the market nature, it wants to retrace to key levels in order to push to the other direction. So corrections, pullbacks. Now price will come here, and the key level itself is below this low. So this one is not a valid market associated, because price is only retracing to this key level in order to go higher after. So instead of doing this, instead of looking for the last low, what we want to see is the break below two lows. And it's better to even look for significant lows. That means when I say significant, it either respected a level before or it created a breakout structure. Now, it's not just a low that is internal, something like this, maybe something like this, where we break one low and another one here, not like this. What I want to see is a break again of two lows. So as price is going up, and this, all of these methods, they need to be aligned with a higher time frame key level. So as price is going up, let's say this is a 4-hour level here, and this one is 15-minute structure. As price is going up, and if you notice, we have this low that broke structure, and we have this low that also broke structure. Now, when price goes to these levels, so we have something like this, what I want to see is I want to see a breakout structure below this, because if we only broke below this low here, and then we started going up after, that is only what? A retracement, a pullback in order to continue higher. However, if we also broke below this low aggressively, that kind of confirms. Now other times it's gonna fail too. So if you're, sometime price is gonna go below this, if there is another key level below. However, just by adding one more breakout structure, it increases your probability of only looking for and identifying high probability breakout structure. So now what could happen is price going up and then retracing and then continuing lower. And you can always apply this. So you notice we have a low here, another low, breaking below both. Now we look for retracement in order to continue lower. Now, if we go to euro dollar here, you notice whenever we have, so we have this high and then this low, broke structure. What happened is, even though we went below this level, which is this last low, that also has some other key levels below. So if you notice, price only went back to a key level, which is this one here, and then continue going higher. So this break here meant nothing. Now, when we go and look for valid highs and lows, and we want to find a structure that is actually, that has a valid structure or a valid low. So if you notice here, this low here broke this high. So it's a low that took a high or broke a high. This one as well broke above this high. So we have two breakout structure. That means we have two lows. Now this one is internal because it did not break anything. When we went below this, I also want to confirm by breaking below this. And when I have a break below this level here and it displaces below, this confirms that we might have a valid breakout structure because we broke below two significant lows. And then what happened after? We take our fib and we look for the range that we created. We look for OTE in order to look for entry. You might find an entry here depending on what key level you're looking at. Now, if you're looking for edge model here on the strategy that I teach on Edge School, we have it here. You find an entry here, just right here. Stop loss goes above the key level, and then you can target the external range, or you can also look for some other key levels below. Now, this one, very easy method. However, it actually takes your win rate from way lower to much higher just by adding one more breakout structure. Now, one type of market structure trap is that whenever we have prices, after this huge breakout structure to the upside, we created a low, another low, and another low. And all of these actually broke structure. So this one, a breakout structure, and this one, another breakout structure. However, the size of the breakout structure compared to this main one, it still remains insignificant. And if you notice, where is the nearest key level inside of this range? The whole range here is unfilled. Where is the nearest key level? It's this one here. And that's where price actually fakes out below and then started going higher. So in this case, you want to still follow this external range because this one does not matter. We only went below the last low before the key level. So here, even now, this is regardless of the key level here, but when you add that to, you have a much higher probability. Now here, when we have all of these internal lows, and then we have the one that has the nearest key level, you also want to avoid this. Even if we break below two lows, if this one has a key level below, it's still invalid. Now, one example that we can see here, so this is the current market structure on euro dollar. And in this period, I remember an example, a good one happening here. And when looking back, I remember we've taken some trades here on It's-Go with my members. Now, what happened here, if we go and analyze what happened exactly, is that here we had a high, we broke above, we retraced lower, and then we started going up. Now, what you notice here is that this is the last high before the break. And I'm going to show you my high probability, how it looks is something like this, where we broke above a high, we respect the key level here, and then we broke below that low that respected this. When I have this, this is the valid breakout structure. Now, if it has multiple touches, it's even better. So where do we look for the market structure shift? Below this low. Now, I'm going to give you 5 seconds, or you can pause the video here and try to find this in here. Where can you see it? Now, we can see it here. If you notice, we broke above this high. All right, we break structure. We did not respect this high. And then we broke another time where we have now this high. And what happened is a respect of that high. If you notice, this is a high broken above a key level, respected here, and we started going up. So now we have a respect of that level. So as we're going up, and then we started going lower, we respect that level. That means now this low is actually a valid level that we can look for short from. And then we broke below it. Now, I was a bit confused about this low here because the break, price immediately started going up, but it's still a valid closure below. I would really prefer another candle to close below, but it's still a valid example. Now, we broke below this, if you notice. The same level that we marked here, where it was respected here, now broken below. That is what a high probability breakout structure is. And if you notice, after the break below, what happened is a retracement up. And even if you were not sure about this closure, another closure here that is very strong, and then it went lower. What happened after is retracement to the same level that we talked about, another retracement to the same level. Now, an edge model that can be taken here is this one, and then stop loss goes above, and you see snapper entry exactly. So you had almost no drawdown, actually no drawdown at all. It just gets you in and then start going lower. So if you notice, this is a good example of a valid breakout structure. Now, another one, so we have this level. Now, I'd really prefer for price to come here to the low. So if this week was a bit here, and then if you notice, we respect that level, we started going up, and then we were staying here, and then we close below. So another respect, and then we close below. This is also another valid one. And if you notice, what is this? After this huge move to the downside, retracement. So this one was a huge one, and there was no retracement here. However, if you notice, this level has been respected multiple times. Now, what is another example? I'm gonna go and find one with you. All right. So another example that I just saw here, you see failing to displace above this and then going lower. Now, this might not be the clearest one. However, it still initiates a reversal. Now, if you notice here, as price is going up, we have this high that price retraced back to and respect. So that is one level that can be actually also a valid level to look for market structure shift. All right, but then after that, there's also another level where we started going up and we broke above this high, and then we also have another respect here. So another level is also here, and if you notice, a high respected by a low and then broken below the low. And if you notice, where does price retrace back to? The same area going lower, and also same level here. Now I would really prefer to always enter when we have the market structure shift happening. That means if I have something like this and then we broke below, before price continue going lower, I'd really prefer to be involved immediately. Before price going lower, now this becomes a bit lower probability because the move could be already done. All right, so yeah, this is the edge call method. It's something that, you know, I always apply, which is an example here. As price is going up, we have a high, this high. If you take it to the wick, respect here, and then broke below. What do we do now? This now becomes a valid. It's not just the last low, it's a low that is significant, and that's what happened after. Price coming back here and then pushing lower, and that is a valid breakout structure, instead of just looking for, you know, random things, which is not gonna work. Confluence for candle open dynamics. Now, a lot of people don't pay a lot of attention and they do not focus on the opening price. However, that opening price, and when you align it with the lower time frame, when you understand how the candle is actually opening and the way that that opening, you know, the price action around the opening, that can decide if we're going to have a reversal or continuation. That means if we have a bullish candle, depending on how price or that, you know, next candle open, it could either continue as a bullish candle or it could reverse and then goes and become bearish candle. So the open sets the tone. It's all about the opening price, and this is one thing that I always focus on. Whenever I'm entering a trade, I'll be focusing on how the candle is opening. If I'm looking for a reversal, I want a specific thing to happen. If I want a continuation, I want the opposite. Now we have two things to focus on any candle. So this is a bearish candle and this is a bullish candle. Two things to focus on: opening price, that's the most important one. The other one is either a high or low of the candle, depending on the color or the bias of the candle. If we have a bullish candle, we're going to be focusing on the high more. So this is a note here for a bullish candle. A high matters most, and for a bearish candle, the low matters much more. So this is, you know, we're going to be focusing on a high for a bullish candle and a low for a bearish candle. Now, both high and low for every single candle are significant. However, what matters more is a high for bullish and low for bearish. Now, examples are going to make this much clearer, but we need to understand this. This is just candlesticks 101. So this is the opening. This is the highest price that this candle reached, and this is the lowest price, and this is where it closed. Now, for a bullish candle, this is where it opens. This is the lowest price. This is the highest price, and this is where it closed. What matters here is the opening here for a bullish candle and the high as well. And here, the opening, it's always the opening for every single candle, and the low matters more than the high. Now, this is a summary. Probably is going to take you days and weeks to understand this by yourself. However, I'm giving this for you in an easy way. Now I'm going to be using a bullish candle as an example. For a bearish example, just flip this, just do the opposite. And we're going to be going over some examples later for bullish and bearish. Now, for continuation means that if I have a bullish candle, I want the next candle to be also bullish. That is a continuation. So following the previous candle color. Now, for continuation, what I want to see is I want to see price start going below the opening price, holds the low. So this is the first step. Second step is holding the low and continuing up, breaking the high of the candle. That means price starting going below the opening price. So we have a candle here. This candle needs to go lower first, creating a wick. So started to go lower and then breaking the previous candle high. When this happened, this is a continuation profile. Now, what happened here is simply doing the opposite or going into the opposite direction first. Now for continuation, again, candle, next candle is opening lower and then going higher. So if it opens lower first, that is a continuation profile. For reversal, price need to go aggressively up without going below the opening price first. That means this candle here closed, next candle needs to go up immediately first, not going below. So not going against the direction, but with the direction first. Now when this happens, without going below the opening price, failing to displace above the high indicates a reversal. So this is a candle here, this is the high of it. If we open here immediately going up and we fail to close here, it's going lower, this is a reversal profile. Now in this session, there is times where continuation is not going to be clear and a reversal is also not going to be clear. Now that is indecision. It means that price is failing to displace above the high or low and stays around the opening price. So we're not being able to, go above the high or go below the low, and we're staying around the opening price. So we go above it, we go below it, we go above it, around it, and we don't have a clear direction, and we don't break above a high or below the low. Once you understand this, you'll be able to know when to look for continuation and when to look for reversal and when to stay flat and out of the market. These three cases and scenarios, it's what I do apply to every single trade that I take. If I'm seeing price going up and I'm looking for a reversal, I'll be looking for this reversal profile to happen here in order to validate the idea. It's gonna make this much higher probability. And the whole series is about what? Finding and looking for high probability setups, and this is part of it. Now the general rule is that if price moves in the same direction from the opening price, that is a reversal. If we have an opposite move to the direction, that is a continuation, and that is the general rule. So if we have a bullish candle, if we open with the direction, mean going up without coming lower first, that is what? A reversal. If we go the opposite move, so if we are bullish and then what happened is we started to go bearish first, that is a continuation, because after that we're going to be holding the lows and we're going to continue to the upside. Now if you understand this, it's like you already understood all of what we discussed before. Now just a disclaimer that I'm not going to go over all the details and all of the different setups, because this is something that I'll be teaching on my community, on my mentorship at school. So there is going to be a course called Candle Continuity Theory. This is one of the concepts that CCT, one of the concepts that I give some introductions and some information about. However, I did not go over the details. And in this class, I will be going over all of the details and all of the strategies and all of the details you need. But for this video, I'm going to give you the basics. You can actually start from it and you can benefit 100%. Now, this is dollar franc on the weekly time frame, and we're looking here at the weekly time frame because on the next episode, we're going to learn how to actually use the higher time frame candle bias as your clear direction to only look for trades in that direction. You're not going to be able to understand that episode if you don't understand this. So make sure to understand this, even watch it multiple times if you want it, and then you go to the next one. Now, the candle open dynamics is all about where we open. In other words, how did we open around that opening price? What did we do around that opening price? Now, I'm gonna go over a few things here. I just want you to notice one thing. As price was going up, when did the reversal happen? Now, it's not gonna be always that type of reversal, but a lot of time it's gonna be, what is this? If you notice. Now, I'm gonna go over some circles here. I'm gonna highlight some of the price action, and then I want you to think with me what happened here. So here, as well as here, and then I can go over a lot of other examples, but here, it's happening around the extreme levels, where price actually flipped for months. So here, and it did not happen here, but it happened here, and then it happened here, and then here as well. Now this is enough for us. Also, we can watch this one here. There's one here as well. Now, if you notice what happened here, that is different than what happened here. So why did we start going up here? And then at some point we flip bearish. What happened here that is different than this? What happened is, as we're going up, or we're going down here, for example, we're going down. What happened? Let's zoom in now. So zooming in, if you notice, we're able to open here. So this is where price or this candle open. It started going up first, print the high, and when we move against the initial direction, that is a continuation. It means that we are printing the high, in this case it's a week, so we're printing the high of the week, and then we're breaking below. The moment we have displacement below the low of the candle, that is a confirmation that we're going to be going lower. Now notice what happened here instead. What is different than this? Now the difference is right here. What happened is, instead of whenever we open here, it looks like what happened is price going lower first, below the opening price. So it is with the direction. So this is a bearish candle. It started going lower first and then failed to displace below the low. Now here's the difference. Here we were able to displace below the low, and here we failed to displace below the low. That means we're probably going to be having a reversal. And then the moment we stay above the opening price and we close here, that is a reversal. Now you could trade here, right? So you could have a trade here and then maybe inside here, just below the opening price. And then after that, whenever we close, that is a confirmation that we could actually be going bullish. And if you notice here, now we decided to take the low again, but here, the moment we open, we started going down first. I'd really prefer to see the low being respected, but in this case it didn't. Now we open below, we started going up. That is a continuation profile, and that is what happened here again. We open lower and then we started going up. We open, and same thing here, we open lower, and that is the wick, that is where you can enter. We started going up, and same thing, going up, going up, going up. And you see, every time we displace above the previous high, we go lower, we open lower, and we displace until here. What probably now, sometime you're gonna have some other details on the lower time frame. Now sometime it's not gonna be too confirmed. Now we're only seeing what happened after. Yes, but here what we see is that probably we open, so we open maybe first going lower or going up. The highest probability here is opening higher with a direction. That's gonna mean a reversal, especially if you're reaching a key level. All right, so key level here, reaching that and failing to displace above the high, and opening immediately and aggressively above the opening price. That tells me that there's gonna be a reversal here. And then price started going lower, and you see, the difference here is that we had a continuation. We opened higher and we displaced below the low. And same thing here. So if you notice, it's either a continuation or reversal. Here we have a reversal. We did not displace below the low and we started going up and we close above the opening price. And this is what you can always apply. Even a small move like this on the weekly time frame, you can actually catch a good trade just using one candle. Now, this is simply if price is going up, so, or going down, let's make this a bearish candle. What I want to see on the lower time frame is price to open here. The best case scenario for continuation is opening up, all right, which means that it's going against the direction and then reaching a key level and giving you a confirmation, and then you enter from that and then you displace. So let's say this is a wick here, it's the low of the candle. The moment we also displace below this, it's a confirmation that we could have a continuation. That's what I want to see. On the other hand, if I want to see a reversal in this case, that means I want to see price moving higher and we're reaching a key level. I want to see price opening and immediately going lower and then failing to displace up below this and then going up. Now, if price was able to displace below this, we might actually have a continuation. And sometime it's gonna go up and create a wick and then continue lower as well. And we do have a lot of different setups, a lot of different scenarios, which I'm gonna be going over just my mentorship. But I think this is enough for you to understand. Now we're gonna pick one of these. We're gonna go to the lower time frame and notice what happened, in the lower time frame, what happened exactly there and how can we enter this. So let's take this as an example. So what matters here is the high of the candle and then the opening price. So these are the two important levels, because these two levels are going to decide if we're going to have a continuation or reversal. Now, yes, the low also matters, so I'm gonna pick the low here. Now we go to 4-hour time frame or 1 hour, whatever. Any time frame that you think you can actually trade with. Now let's notice what happened here. So you see above the opening price and then above the high, we're gonna see what happened exactly on the lower time frame. So price opens up and then immediately goes lower. Now, if you are not sure about entering here, you do not enter. You only wait for your key level here. So you do not force anything. Sometime you'll be missing trades, and sometime you'll enter trades too early where price did not reach the key level. So let's see what happened now. Price still goes up again. So, or it goes up, but it did not go below the low. So it did not confirm anything as of now. But then it started going up and failing to displace above the high. And now if we take an edge model, for example, this is one of the setups that I teach, shorting here, because now it feels like we're failing. First of all, we started going up aggressively, only one candle going lower. So I'm gonna count this, the majority of the move is to the upside immediately above the opening price, failing to displace, and this tells me that probably we could have price moving lower. What can I target here? In this case, you could target the opening. Why? Because around the opening, it's where the direction or the decision of the direction is made. So if we react of that level, we could probably continue up. If we don't and we break below, we're probably gonna be going to the low and maybe lower. So playing the price action, you see, it found support here at the opening price, and then we have another key level here, and also of the opening price going lower, finding a resistance, and then taking the low. So this is probably a trade that you could have traded here. Now, if you take a low time frame entry, it's going to be much reward to risk, and then price goes lower. So that's how you trade reversal. Now for continuation, how do we trade continuation? Now see, this one here, we already established the direction here, which we're going lower, and we've taken an entry to the lower side. Now what happened after is this close bearish. So for continuation, what are we going to be looking for? For continuation, because this is a bearish, I want to see another bearish candle. Now for this one, you want to mark your opening price, because this is a bearish one. Now what matters more here, the low or the high? Definitely the low, because it's a bearish candle. So we're going to be marking this, and we're going to go to the 4-hour time frame. Where do we have the opening? So it's Friday here, and this one is Sunday. So we started going up, creating a wick here. So we traded above the opening price, and then we started going lower, depending on, now I'm not going to be considering this always as the high of the week or the wick I'm gonna be selling from. No, I want to wait for this low and see, do we have a displacement below or no displacement? Now that's what I love to see, is price going up into above the opening price and then going lower. Now in this case, we reach a key level here. If that makes sense for you, you could be selling from here, and it's like predicting that this is gonna be the high of the week. Now if you go to the low time frame, you find a confirmation, you could be taking that one. But based on the ranges, based on the market structure, some people would be taking a trade from here. Now let's say you take a trade from here, all right? And then your first target, you want to look for displacement below this low. If you don't find any displacement below this low, I would say you can exit the trade and look for another entry maybe higher. Now playing the price action, so no displacement here, but then we close below and then we close below. So this is a continuation. Now I want to see what happened here. Is price finding resistance at the low of the candle, and that's what I love to see. If price wants to continue lower, it wants to respect the low and then continue going lower, and that is a continuation trade. Now you notice we've taken a reversal, but then after this reversal and this candle closed, we now have a probability, or another chance to look for continuation, and our continuation is bearish, and that is a continuation trade. Now sometime price is going to give you much reward to risk, and sometime it's going to reverse and give you another reversal. But in this case, if we notice, as price is, so here we have a reversal. Now, whenever you have at this candle opening, if you were in a trade, you need to be exiting the trade. So go into the 4 hour again here and look at this. So you could hold your trade until here, and when this candle, new weekly candle open, so I'm not gonna say here, but let's see where can we exit. So price start going up first, so it's good for us, which is probably a continuation. However, what happened after is price failing to displace below the low for 1, 2, 3 candles, and then close higher. After this, I'll probably exit here, maybe after this candle, this engulfing candle failing to displace below and then closing higher. So probably you want to exit here and now look for longs, and then you wait for another candle to either be a continuation or reversal, and then follow and rinse and repeat. But you will need to be having, this one is something you need to use in addition to your current strategy, because it's not a strategy itself, unless you use the the patterns or the setups that I teach on its school regarding the CCT, then yes, you can, but you need to have a strategy in order to enter these. Now, yeah, you could have a setup here if you wanted, and then price goes up. And if you go to the weekly, now you could do this on any time frame. And we're going to be going over a lot of examples. Now, this is the basic of it, okay? And this is what you need as of now, which is understanding how the candle open and then going further. Now, one more thing that I do want to mention is that imagine we have a bearish point of interest or a bearish key level, and price is going up. All right, so it's a all bullish candle going up, going up, going up, going up, going up, and then before we reach the key level, we do have, now let's say this is a higher time frame key level, and now we are on the lower time frame, and this is a bullish candle here. So bullish candle, and then another bullish candle opens as a continuation. So I'm not going to be entering here at all. So price is moving up, and then we create a wick to the lower side, and then we broke above the high. You only want to look for trades when you have a reversal profile. So let's say we have a scenario like this, where this candle closed like this inside of the key level. I will still not do anything. And if we have another displacement above the high, I'll do nothing until I see that price opens higher immediately to the high and failed to displace, and then started to go lower, printing the low of the candle and then displacing below the opening price and below the low and breaking below. In this case, especially here, when you open, you want to look for shorts, because now you have a key level that is bearish and then a reversal profile that is bearish, and you can enter here based on this candle, or you can look for the continuation on the next candle. How is the continuation gonna be? We have the low here, price is gonna go up, open, go up, and then break below. You could look for the continuation after that to the lower side. So again, you could apply this on a higher time frame, on a lower time frame, even 15 minutes and 1 minute. If we go to the chart here and go to 15 minutes and just look at the chart, you're gonna see that now the frequency is changing here, because we do have a lot of more opportunities. But not just this, price opens lower, goes up, or price opens lower, goes up. Here we have a reversal, here we have a reversal to the upside, and then price, you see here a lot of continuation until we have this small reversal. Price goes up, we have a reversal, and then continuation here. Now, even if we look at this here, this one, where we actually take the low of the 15 minutes, if we take a look at this on the 1 minute time frame, what happened? So this is the opening of the candle here. So it's here. This is where the next candle opened, the 15 minute. Want to see what happened here? We have not made any wick to the upside. What happened is wick to the lower side and then closing higher. In this case, what can you do? You can actually look for longs, maybe here, or maybe at this closure of the candle, depending on what type of entry you take. Now you see, price goes lower, somehow sniper entry. Now this is one of the key levels that we teach in school. Price goes up, all right, and then you see, even though it's just a 15-minute candle. Now let's go back to 15-minute and look at what happened here. Even though it's just a 15-minute candle, you could have gotten a lot of reward to risk. And sometimes it's much more. Just like, for example, let's see, we have nothing here. We don't have this. So sweep going above and here too. So a lot of opportunities. The thing to make clear here is that this could be used on any time frame, and you could have the higher time frame to lower time frame, or just the higher time frame by itself. So a lot of different ways to trade this. Influence 5, price behavior analysis. Now we already in the previous lectures of this series, we've talked about price position, about ranges, about structure and valid structure, and about candle open and bias. So all of these 4 things here all help us with identifying key levels. But today we're going to be looking inside of the key level, not identifying but validating the key level. Now price behavior goes into 2 different aspects. The price behavior of approaching the key level and price behavior inside the key level. So 2 different things, and we're going to cover these. Now the first one is telling me even before price goes into the key level, it's approaching the key level. It tells me if it's valid or not, and if I should use it or not. And then inside the key level, and that is the trigger. So talking about approaching the key level, we have 2 main approaches here. And these are the 2 that you want to focus on and avoid everything else. And in the examples, you're going to notice how only if you apply this, it's going to make a big difference in your trading style and your setups, okay? You're going to be focusing more on valid key levels other than levels that are even just looking at the approach of them, they're going to be failing, okay? So the first one is the impulsive approach. That means, and a lot of people mistake this, they think that if they have a key level and prices come in aggressively to their key level, it's gonna not hold, okay, and it's gonna fail. The reality is though, the more impulsive it's coming to your key level, the better it is, at least for me. And why? Because fast, aggressive move, it often signals exhaustion at the level. So if it's coming very strong into your key level, at this point, because it moved aggressively for some time, it can find exhaustion at your key level, and that is what you want, okay? And for this one, for the impulsive approach, it's gonna end up and it's gonna have a sharp reversal possible. And this is what I do, and it's cool. Actually, a lot of time, if you're catching a reversal, I want to see price coming up aggressively because it's gonna go down aggressively. And that is why impulsive approach is making a big difference in my trading style. Now I do validate key levels by how impulsive prices come into them and approaching them. Now we do have another tab, which is the corrective approach. It could be as a channel, as a trend line, as a flag, okay? That is a clean retracement. It's for me a higher probability that the level will be respected, but in another way. So it's not going to be same as the impulsive or price reverse aggressively. Now really it's going to be in a different way, and I'm going to teach you this in the examples. So these are the 2 only approaches that you want to focus on. The other approaches do not matter. You need to keep it simple. I want you to focus on these. There are a lot of different ways that price could approach your key level, but this is what I want you to focus on because they're going to give you the best results. So let's look at some examples regarding the approaches into the key level, the types of approaches. Now, one thing I want you to see, now I'm zooming out in the chart, and this is $1 on the 4-hour time frame. I want you to notice every time price goes aggressively somewhere, it's going to reverse aggressively. So if I can notice here how price was going down aggressively, at some point, look at the reaction, even though it slowed down here, but then into the main key level and then pushing up aggressively. So when price goes to a key level aggressively, it's going to come out of it most of the time if the key level is valid, or based on probability, you're thinking of price coming out of that key level also aggressively. That's one of the approaches. And I always love to take trades like this. And why? Because whenever I take an entry, price is going to go up aggressively. First of all, giving me high reward to risk. And then price is most of the time not going to come back to my entry. So if you notice, if you enter here after this strong push to the downside, impulsive move, price going up here, you enter somewhere in here based on the edge model, based on any type of entry you have, and then look at what happened after. Price never come back to this entry here. Price just keep going higher after, and then even if you go break even, you are safe. But a lot of other times, if we notice, whenever price, if we have a key level here, okay, whenever price comes down to that key level, and whenever it goes close to it, it's slowing down and the structure is becoming way too weak, and then you have a lot of noise. This noise here, or this small structure, what's gonna happen is gonna continue here, and then until we cannot go long now until we see some strength happening, because whenever we have price coming down aggressively, it means that at some point it's gonna have, or it's gonna get exhausted, because now it's coming down in a very aggressive way. At some point it's not gonna be able to continue, so we might have a quick reversal. It's gonna have exhaustion here and then strength. But in this case, there is nothing happening in the beginning. Price is just slowly coming lower. That means a lot of times in this situation, what I wait for is, not enter based on the key level that I have, and then wait for a strong move either to the upside or downside. So this could happen downside and I'm gonna enter here. And another scenario that could happen is finding strength from here, and then I can look for the continuation. But when we have this type of price behavior approaching the key level, this is something that I don't want to see. Now there is the other tab, which is the corrective one, where price have a structure and the structure is big enough, and then it's doing something like this. This could still work, and you want to focus on the last leg of price action coming into that key level. You want it to be a strong move. You don't want to see a very weak move, and after that we can also look for long entries here. Now we're going to also cover the internal one, or the price behavior inside the key level. Now take a look at this. As price, for example, I do have, for this structure, we're going up, okay, and I do have a key level here, and notice what happened. As price is going up, coming lower, going up, notice how strong this move was. Very impulsive move. After an impulsive move, price is overextended here to the downside. Based on the structure we have, this move is very strong to the downside. Expect the same to happen on the upside. Now based on the key level here that we have, taken an entry, and I think we have executed this one together, not sure, but this is a pure edge model. You enter here, going up, and look at how price moving aggressively instead of other times where price is ranging, when price is just way too weak here, there's no impulsive moves. But notice when price moves aggressively, it's a lot of time over exhaustion there, and it's gonna reverse also aggressively. Now a type of the corrective move, I think we have, notice this one here. Even though price was going lower slowly, and if you notice, it's in a type of corrective move. So if we take a trend line here, it's going to show as a trend line. So price has been, or also a channel here. And if you notice, as price is going lower in a channel type, when price reaches the key level, you can look for longs. Now here, it's a bit tricky. I'm not going to say I've entered here. It's a bit tricky, yeah. Then after that, if you notice, price move up. So this is a corrective move. This is also another corrective move, but this one is a bit more impulsive. So this one is still a corrective move, more impulsive. And when price reach a key level, you can still look for shorts. And if you notice, again, same thing. So you don't want to see price approaching your key level in a ranging way. You either want it to be in structure, so it's coming down in a structure like a channel or a trend line or a flag, or you want it to be very impulsive. So price is going down without any retracement, without nothing. Know that at your key level, if price is already overextended, it might just push up the same way it was coming down. So yeah, for example, if we notice, if we go back here, yes, it's coming down in a channel way. If you notice here, into your key level. Now in this case, it was taking this low into an imbalance and then going higher. And if you notice, after taking that low, there was nothing here except price pushing higher. Yes, another retracement and then pushing higher. And also here, whenever we have strong move like this, no matter what, if we have a key level, and even if it's against the trend, because we had an impulsive, there needs, sometime we're going to have exhaustion somewhere, and you can even take entries here to the downside. So in simple terms, what I want to see at my key level when price is approaching, I want to see either a big structure coming up to my key level, or I want to see an impulsive move, which is gonna give me another impulsive move on the other side. I don't want to see, as prices come into my key level, slowing down and a lot of ranging here. Whenever we have this, we need more confirmation to enter, because this thing here is going to tell me that we either have a break to the downside, which you need a confirmation for, or what could happen is a break to the upside, which if you entered earlier is going to result in a loss. So now let's talk about the price behavior analysis, but now inside the key level and not just approaching the key level, but what happened inside the key level itself. Now think about, price approaching the level is validating the level, means that before even price reaching the key level, I'm validating if the level is good to use or not. However, the inside price behavior, so when price goes into the key level, that is, think about it as the trigger, telling you when to take the entry, and that is the difference. So here we have three main triggers to focus on. Now, some people would have some other key triggers. These are mine, and these are the ones that I prefer to see inside of a key level. So this is our key level here. What I want to see inside is 1, 2, or 3. And I could blend 2. I could have all 3, or I just could look for 2 now. So let's take a look at the rejection. So at a key level, if I see price is going up, having a candle with a strong wick and a long wick, that is simply a strong rejection, and it means that the level is respected already. So a lot of times this is your signal to just enter the trade, because now you have a long wick. It tells you that the key level is filled, the key level is already respected, and you can take an entry. My problem with this is that a lot of times when we have a long wick, it's still gonna, so let's say we have the wick like this. A lot of time price will still go a bit above into the wick and then continue lower. It's not going to give you the best reward to risk. Now, another thing that I want to see inside of the key level is a sweep. So key level, what I want to see is a creation of a strong high or strong low. In this case, a strong high, which means that I want to see a fake out pattern inside the level. That tells me that sometime, a fake out needs to be also with a wick. And a wick, when I have price going up and then going lower and then going above the high with a wick and then reversing, this tells me that there is weakness inside the level and there is price respecting the level, and I can take trade based on this. So when I see a fake out, I mean price going above a specific high or even the highest high inside the key level and never closing above it. Something like this, then reversing, and I can take the continuation, or I can even take a risky entry at the fake out itself. And I do actually have a very specific strategy just using this based on sessions highs and lows. When I have price failing to displace above specific session high, we take a short immediately, because based on probability this could work and result in a lot of reward to risk. Now the third trigger is acceptance. Think about when price is, we have a key level here and it's a bit big, it's a big range, prices going up, and we're still staying inside of the range or inside of the key level actually, but the key level is way too big. If the level is bearish and then price goes into it, reject, and if I could see the sweep, if I could see the rejection, now inside of the key level I can see price going up and then we have a rejection, but price is still inside. Acceptance means that we see this or both at the same time, and then we come out of the level. So now price went to the level and then it's coming out of the level with a strong structure. This means, there needs to be a closure below, and that means we might have a continuation most likely, and that is what acceptance is. It's basically price going into the key level and then closing out of it in the same direction. If this bearish, we want to see a closure below. If we have a bullish level, we want to see a closure above. And a lot of time, this could be enough signal in order to look for continuation in the same direction of the key level. Now, one rule that is really important, and it's going to make a difference for you, you want to match strength and weakness. So strength with weakness, think about it this way. If the approach was strong or impulsive, what do you want to see is weakness inside the level. So when we have a strong impulsive, you want to look for either a rejection or a sweep, and then price gonna go in that direction. If the approach was corrective or weak, and a lot of times, regarding the levels or the approaches that I said I don't want to see when price is moving very slowly into your key level, in that case, and even if you wanted to enter based on this, what you want to look for is a strength inside. So we want to see acceptance and then drop out of the key level. In that case, even when the price behavior is not that good, you could still look for an entry and take the risk if you have a clear acceptance and a drop. But then if price was coming aggressively and strongly and impulsively into your key level, you could just look for rejection or a sweep, and that's going to be enough entry for you. So you want to match the strength and weakness together. When you have strength approaching the key level, you want to have weakness inside the key level. So let's look at some examples here on the euro dollar chart, and these are some key levels that I'm marking here that I always take my trades based on, okay, and based on the edge model. But for this video, what I'm going to teach you is take a look at the triggers pattern that I taught you and apply them to these random key levels here. Now, because we're using 4 hour here, we're going to go to 15-minute to look for the confirmation. Now let's look at the 15-minute, and we're looking at 3 things here. Now you could have your own confirmation pattern, okay? But the 3 things that we discussed are sweep, acceptance, and then rejection with strong wicks and big wicks. Now let's take a look at this key level here. So this key level created on the 15-minute, we want to look for confirmation when price comes back to it. In this case, you want to at least blend 2 or have them as confluences, and then use logic 2. Okay, so if you notice here, as price is coming back, and depending on how big the key level is, so if the key level is way too big, you could refine. So if I'm just using my method, I'll refine to this key level here, okay? But I want to teach you everything about it, okay? So for any key level, so let's say you're just looking at this big level. In this case, when the level is too big and then price is just coming to the beginning of it, you either need to have a stop loss below the level, or you could refine it, or you could wait for more than one confirmation. So instead of just waiting for one tab of trigger, you could blend 2 and then wait for more confirmation. If the level is small, then it becomes, you can take actually much more risky entries. In this case, this is the key level. I want to see what happens. So as price is coming lower, here only price have a small wick and then close higher. I'm not gonna say this is way too convincing to take a trade based on. Price goes lower. In this case, I might take a trade based on this, maybe. But for me, I would always wait for some refinement, and I'll take based on some key levels deep inside the key level, okay? On the lower time frame, based on the higher time frame. But in this case, we see that price put a wick, rejected, and then there is acceptance here. So you could have taken an entry based on this, but then because the key level is a bit big, or you could have it below and then getting stopped out. So let's say you get a stopped out here, okay? We have a strong wick and we have rejection. For me, honestly, I would put it below here, even if it's gonna result in lower reward to risk. Now, take a look at what happened after. We have a sweep, and the price goes up, but it's still very weak. What happened after here is another sweep into the refinement, and then we have a rejection. A lot of times you can take here the entry based on 2 triggers. What we have here is a liquidity sweep, and we have a rejection candle. So what could happen here is have a stop loss below the level, okay, and then targeting whatever. Now, if you want to look for another confluence as well, what we have here is 3 things actually. So 3 things happening at the same time for this last one, and that's why this is the real one. This is the one that had no drawdown at all. What happened is a sweep or fake out pattern, no displacement, weakness, you can call it whatever, okay? But I'm just used to say fake out. So you have a fake out failing to close below, and then what happened after? So 3 things. First of all, sweep, and then strong rejection, and then finally acceptance, which is coming out of the key level aggressively. So this is 3 things happening at the same time. That's why this is the most valid entry that you can take. And take a look at after price keeps going higher. Now we have another key level here. Okay, so based on the 4 hour, this is the key level. You want to do the same. You want to look for the trigger. What is a trigger? Now take a look at here. Price goes into the key level. There is acceptance here. There is a bit of a strong projection, okay, but the level is still big. So what you can do is take an entry at the acceptance, because now you have two things, but no sweep. There was no fake out. So you're going to have the limit order now, regardless of the timing of the day here, because usually no one is going to trade at this time. Now let's take a look at what's going to happen after price is going in, very close to the key level. There is a sweep here, not inside the key level, but of another key level. Price goes up. In this one, probably still not entering. I want to see price goes a bit deeper, because we already have the first retest of the level here. So I want to have another retest that is below this level. So what happened here is, here we have price taking the low, also taking this low, and then we want to see what do we have. We have a fake out of this low, and we have rejection. So if you notice here, this is a strong rejection, and then price is going up. So we have two things now. Where's the third thing? Price accepting the price and then going higher. So here we have three things. We have acceptance, fake out, and then rejection, and also another rejection here. So this could be your entry, and then if you notice after that, price just goes up strongly. Now we have another key level which is created here. Price goes lower, and the retest now this is where price goes to the key level. In this case, because the level is way too big, and in this case we have no sweep or fake out, this could be considered as a fake out, but it's not actually. So what happened here, maybe on another time frame, you're going to see it as a fake out and then rejection, okay? But on the 15-minute, which is the time frame that we're using here, there was nothing. So you could consider this as a fake out. Price going lower, having some reaction around the key level, the beginning of it, closing up. And here at this candle, we have the acceptance. So even though there was no clear rejection, actually, I can see that on another time frame, this would be a fake out and this is a rejection. So we have acceptance here, and you can take an entry based on acceptance. Stop loss goes above, and if you notice, price going lower, and that is some good reward to risk. Now, after that, if you notice, as price is going up, what happened is a sweep or fake out, and then another acceptance, which you can take another trade based on. Now, take a look at here. Price was going up. That's a key level. Let's see what happened on the 15-minute. Is price, we have this low that has an imbalance below. What happened is, and this is a whole key level here in the 4 hour. What happened on the 15-minute is price going down, taking the level. Okay, even though the timing is not good, so probably not going to be taking this trade. But if you notice, price takes the low and then close higher. Do we have a strong rejection on the low? Yes. That means we have first trigger. Another trigger is also we have the fake out. So we do have fake out. And then after that, we have the acceptance, price closing aggressively above. This could be an entry. And if you notice after that, we have a strong move to the upside. So this is what price behavior is about. It's about looking at the key level. Okay, key level. And then noticing what happened as price is approaching the key level. And then noticing what happened inside the key level, and then taking the entry based on these two. First one, when it comes to approaching, it's about validating the level and just from the beginning knowing if the level is valid or not. And then when it comes to price inside the key level, it's about the trigger, it's about the entry, and it's about the confluences to see inside in order to know when to take the trade. Confluence 6, higher time frame candle bias. So let me start with this. If you have two valid setups based on your trading plan, so let's say price is coming lower, and then you have a valid short setup here, but also a valid long setup here. Which one will you take? So you have a short and a long at the same time. The question here, which one is more valid? Which one is higher probability? Most of the time, you want to take the one setup that actually aligns with the higher time frame candle bias, and that's going to be the one most likely aligning with the main direction. Okay. We're going to be discussing what's that higher time frame candle bias, how to use it, and everything about it. You probably have this problem when price goes up, you look for shorts, and then price give a minimal pullback, goes higher, another pullback goes higher, and in all these pullbacks, what you're looking for is shorts instead of long. So if you have this problem, then this video is for you, because you'll be looking for reversal while price keeps continuing higher, and you'll keep losing more and more and more every time. So for every trade you're going shorts when the bias is simply going to the upside and you're looking for trades on the other direction. How to solve that? Focusing on the higher time frame candle bias. In simple terms, if the higher time frame candle is bullish, and that is the bias now, we're gonna be looking for bullish opportunities, then lower time frame shorts are lower probability. On the other hand, lower time frame longs are higher probability. And if we're looking at higher time frame candle as a bearish one, so the bias is bearish now, lower time frame longs are lower probability. And what we need to focus on is lower time frame shorts that are going to be higher probability when the candle is bullish. So it all depends on the higher time frame candle, and that's where we're going to be looking for the bias to give the direction just out of one candle. We need to apply the time frame alignment from a higher time frame candle to a lower time frame entry, and this is always, the time frame alignment we keep using. So whenever we're using a higher time frame candle or for weekly, I'm going to be looking at 4-hour lower time frame entry, daily to 1 hour, 4 hour to 15 minute, and then if you're on a scalp, you can do 15 minute to 1 minute time frame. So that is the time frame alignment you can use. Now sometimes you can be flexible, you could do daily with 15 minute if you want, but it's not gonna be as precise as the hourly. But then you could catch much higher reward to risk, okay? So that is the difference. Now let's explain everything and put it together. Now we do understand from the previous videos, actually from the opening of the candle, the significance of it. So make sure to watch that one. We understand that there are two ways that price or the candle itself can open, and then we can get the direction out of it. So we use the previous video of the opening of the candle. That's step one. And then what we do is we apply it and we use that bias of the candle on the lower time frame now. So we go from higher time frame candle to lower time frame entry, but we need to follow the bias of the candle. So we need to still apply the concept of the opening of the candle. Now we understand that if price, if we have a candle here, this one is going lower and new candle open here. If we open immediately go into the lower side and fail to displace below this, we might have a reversal. So now what do we have? What is the bias? We have a long bias, okay? Because now the candle is going bullish and we've taken the previous candle low and then we were not able to displace. However, if we're opening here and then going up and we created a high based on structure, we created a high, we go lower, and then at this point, what are we doing here? Probably if it's aligned with the structure, we're going to keep looking for shorts. And this is the candle bias. More confirmation would be a closure below this. And then looking for continuation. So our higher time frame candle bias is going to be bearish here. Now, one simple trick to do here is to apply this indicator. So you're going to go here, ICT higher time frame candles by Fatty. You're going to enable that. And here comes the time frame alignment. So if you are using, for example, 4-hour time frame, then you want to enable the weekly candle. And then if you're using the hourly, then you're going to go with the daily. So let's take, for example, the daily time frame. And this is the number of candles that you can, you want to have on the chart. So I'm going to go with 2 candles or 3 candles. Okay. I want to look for the previous 3 candles, including the current one. So for this one, you're going to go to the current chart here. So this is the chart. I'm going to enable the indicator, and actually I'm going to go to the hourly time frame here because that's the time frame that is lower compared to the higher time frame, which is the daily. So we go from daily to 1 hour. We're going to apply that indicator, and if you can notice here, it's going to show us 3 candles. So this candle is going up, this candle is going up, and this one ended up going lower. Based on this current candle, this is our higher time frame candle, and we're going to be following the bias of this candle. Now you could also do 15 minute. Okay, you could do 15 minute, but now we have more, I would say more noise, but a lot of, you could see this as noise or details in both sides, as long as you know what you're doing. So let's apply 15 minute, for example, to see what you can do. Now, notice what happened at this candle when it closes. So we're going to go back here and we're going to look for examples on how to follow the bias of the higher time frame candle. And we're gonna go a bit on more detail, so not just daily to hourly. We're gonna go to daily and 15 minutes, and this is gonna be more complex compared to daily and hourly, but we're gonna take the hard approach a bit in order to learn more. You can always stick with the hourly and daily. So let's look at this example. This is euro dollar on the 15-minute time frame, and that's the date. This is Tuesday, October 14th. Now this is 17 EST, and that's the time where a new daily candle is gonna start. So if you notice, this is where the last daily candle is. It's going higher. Now sometime we're gonna have bullish candles and then bearish candles, but in a lot of other times we're gonna have bullish candle closing and then also a continuation, depending on the market structure. So if market structure is also aligned with the daily candle, that's when this concept becomes very powerful. But you always want to look for the continuation of the candle, the higher time frame candle that you have. Not continuation, we could have reversal, but based on how the candle opens. So let's notice, this is where the new candle opens. We're going to notice what happened, and we also compare to the hourly to see what happened. So new candle, if you notice, this is the new candle starting here. So what happened is we print a low and then we started going higher. Okay, let's notice what happened. So after that, we're ranging here because the daily candle is just starting, so we're doing nothing. We started going lower, but still we're bullish because this candle opened to the upside, or actually close to the upside. Now we're starting to go lower, putting a lower low. Actually we're still inside that low. Okay, we go lower and then we started going up here. Now based on market structure, okay, because what do we have here? We have this strong level being in a support. Okay, so price has been reacting to this level multiple times here, and then what we had is an engulfing candle closing higher, so this indicates strength, and this engulfing candle is reacting of a strong level. It's failing to close below a level, so we have a lot of confluences. And if you have not watched the price behavior analysis video, then you know that based on the triggers, the three triggers that we have, it looks like we have all of the three triggers here in this candle. This is the candle that has all of the three triggers. Now if you want to take this one, ask yourself, does this align with the bias of the daily candle or the higher time frame candle that we have? The answer is yes, because we are bullish here. This is the candle that we have now. We printed the low, so we already put a wick on the downside, and now we started to go up. So it looks like this could be a good opportunity to go long. Now I want to ensure that we displace above the previous day high, which is this one here, and then we can look for the continuation. So if you notice, what happened is we started going up on Asia, and then on London we continue to the upside. Now even for people trading the London reversal, if they enter here, it's gonna be ending up in a loss. Now sometime, yes, it's gonna work even if against the direction of the higher time frame candle, but if you notice, it's not gonna work. Here, people looking for reversal, most likely failing. At some point, it's gonna work only if it's aligned with a strong key level and structure. But you notice this one is aligning with the daily candle. So playing the price action more. At some point, we had a bit of a push to the downside. Okay, going lower again, but we're still bullish here. We're still bullish on the daily candle. Now, if you notice what happened, same thing as happening here. We had a push to the downside. We've taken the London low. Okay, we're not displacing below, rejection, and then another candle closing higher. This candle here is aligned with the daily candle, so this one is a better entry to take, better than going short. So this one aligns. When I said in the beginning that if you had a short setup and a long setup, which one you take? You will take the one aligns with the daily, or in this, in general, the higher time frame candle bias. For this one, based or aligned with the daily candle. So if you notice, going up, okay, a bit of a retracement, and then going to the TP, and then continuing higher. Now something happened here. So if we go to 17 exactly, so that's when another daily candle opens and then starts. So here another daily candle is being created. Let's see what happened around that daily level. So if you notice, we did not take the previous candle high, or in this case, the previous daily high. So that was not taken. We started going lower. So this push to the downside, no wick to the upside. That means we could have a continuation to the upside. So whenever we have a valid setup to take here, we can. So if you notice, we started going up now just a bit, and then we're closing above. So closure above, going lower. Now, mainly here, it's a bit risky because I could look for a deeper retracement here. So even if we respect, let's see what happened. Price goes lower. And then this candle here is what we always enter based on, okay? So this is a strong candle, taken, doing a fake out into a key level. So if you notice, it's a key level with an imbalance and then closing higher. Because we already have the confirmation that we are bullish for this daily candle, what we can do is enter here. I was a bit late when I was doing the replay. So what we can target is you can look for some key levels here, but you're not only looking for example, 3 to 1. So let's see what happened. Price is pushing higher without stopping. If you look for reversals here, most of the time you'll fail, and most of the time you keep looking for reversal, which is not gonna work for you. Okay, so it's gonna end up in a lot of losses. And now we're going lower, but we're still bullish. So you could always look for, now price I think came back to the opening price of the candle. You could have taken a long here, but now it's getting a bit weak and we're coming into New York. So let's see what happened. Actually, where's the new candle open? We have a new candle opening around, yes, around here. So let's see what happened. So we're still continuing up, as I said. Could have taken an entry here, just a bit of a retracement, and then going higher and breaking everything. So that was a huge trade. Another trade you could have taken is based on the same level that we're looking at. So price respecting the same level that we entered based on, and then pushing higher. So now a new candle, and what you're gonna do is do the same thing. Look for longs as long as the structure aligns with the higher time frame candle, and as long as we displace above the previous daily high in this case. If you notice, we go above, and that is a continuation to the upside. You don't look for reversals here unless it's aligned with a strong key level that will make you ignore the daily candle. Now, if we close bearish here, we can look for continuation, because now we've been bullish for 1 to 3 days. Now we could have some weakness and some reversals, and then you could trade the reversals, and then whenever you have another bullish candle closing up, okay, you could trade based on it again. So I'm curious to see what happened here. We're going lower. Okay, looks like we finally started going lower. Now for the next day, I could look for reversals going lower. But that's the lesson of always being aligned with the higher time frame candle. Now you could apply this to the weekly time frame and then to the monthly time frame. So if you notice, as we close bullish, then it was bullish, and it was bullish, it was bullish, bullish, and then we've taken the high, we were not able to displace, and then pushing lower, and here we took the low, and we actually traded based on this and this on its school, and this is all part of the candle continuity theory. There's more details on it, but I'm just showing you one side or one aspect of it, which is looking at the candle bias. Okay, now what happened here, as I said again, taking the high, not displacing, taking the low, not displacing. And there's sometimes where it's going to be ranging, especially after a long of candles going in one direction, a lot of candles going in one direction. One of the tips that I suggest is that whenever we go lower, 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 and then we close higher, then you want to trade the continuation. The highest probability is trading the continuation on the next one and the next one. After 3 consecutive candles, there's going to be weakness coming very soon. Okay, now it could last for 10 or 20 candles sometimes. But then based on probability, after 3 candles, and based on my backtesting, after 3 candles, it gets a bit weaker. Now you could also do this on the 15-minute time frame and 1 minute. If you notice, you can see a lot of times when we have 15-minute going up, then going down, it's prices following the same direction. And when you trade based on the 1 minute time frame, all you want is few pips, and that's going to result in a lot of reward to risk as well. Okay, so that's the end of the course, and these are 6 confluences that if you apply to your current strategy or new strategy, you'll end up with higher win rate, higher reward to risk, and less trades, but more quality trades. Make sure to share the video with your friends, make sure to hit the like button, leave a comment, and make sure to master all of the concepts here in order to become a better trader. I'll see you next one.